Warren Buffett is sitting on one of the biggest cash piles of his career. Last time this happened, epic deals followed. He is not waiting for market crashes. Rather, he's looking for great prices. So in this video, I'm going to show you how to copy his strategy, not the stock picks, how much cash to hold, when to deploy, and how to keep your emotions from nuking your gains. With that, let's jump in. As always, I would really appreciate it if you like this video and if you subscribe to my channel, especially if you learned something new. So let's jump in and check out what Buffett is actually signaling. First, before we even jump into the nitty-gritty, I want you to take a look at this chart, and I thought this did a great job just capturing really the essence of what I want to drive home. And that is that stocks really do tend to go higher even if there is bad news in the market. What is the overall trend of this graph? And it's over 100 years. It's about 125 years old, this graph. The upward trend, which is really the general trend, shows that even through all of these disasters that we've lived through, our ancestors have lived through in the world over the last 125 years, the stock market has typically gone up. At least that's the general trend, right? You can probably tell that it has gone up. Of course, with the exception of the Great Depression of the late 1920s, early 1930s. But overall, even though there were pretty terrible events, right? I mean, we had, we had COVID, we got wars here, we got World War I, we got World War II, and so on, the market still has gone up. Why is this important? Because I don't want you to fear and worry that, the market is going to crash and everything is going to go bad. No, if we look at history, which typically rhymes, maybe not repeats but it does rhyme, you can see that overall the upward trend is there. The most important thing is that markets do rise over decades, but they also crash, and crashes mean opportunity. Now, Warren Buffett said something pretty interesting, or at least I interpreted it this way. And it's not verbatim, but essentially he's saying that he'd rather miss a meh deal than force a bad one, right? You don't want to force a bad deal. And that's what he essentially, or is likely a driver of why he has so much cash, because cash really does mean opportunity. And cash also means what the investing world calls dry powder. Cash is essentially your dry powder before you go into a metaphorical war, right? In the stock market, at least. When you see the economic signs of a bear market, of a pullback, that's when cash is your best friend, especially then. The goal is not to predict, though. Like Warren Buffett doesn't necessarily predict crashes and is trying to wait it out and then put all of his cash into the market. Rather, he creates something like a playbook. And I really thought this quote was interesting because he said, an idiot with a plan can beat a genius without a plan. So what is the key here? It's important to have a plan in place. And all too often, I see clients of mine, especially when I was a wealth advisor and worked with over 350 millionaires, those that did not have a plan actually struggled the most during great recessions. Especially one couple stands out to me. They did not have a plan. The great financial crisis took place. They pulled out all of their money, stayed in cash for like 5 years, missed the market highs, and are still in cash to this day. So as you can imagine, they actually lost a lot of money, especially now with inflation, and they missed out on a big opportunity, especially after that great financial crisis. They were willing to sacrifice long-term gains for short-term stability and cash. And I wouldn't even call it stability because they locked in all their losses during the GFC. So that's an example of when without a plan, and they were pretty smart clients, I would say, they did not have a plan and it went pretty poorly for them. And they're still suffering the consequences to this day and will for the rest of their life. So the key point is make sure you have a plan. Now let's take a look at all of the cash on hand that Warren Buffett has right now. We're looking at about $277 billion of cash on hand. Now this here is his company, Berkshire Hathaway. Take a look at how this compares, this cash, with all of these other companies that we know from, especially from the S&P 500, the valuation of these companies. Warren Buffett has more cash on hand than Netflix is valued, which is $272 billion, and Salesforce, and so on and so forth. So you can see that there is a pretty large chunk of cash on hand. And you can also see, I thought this chart was pretty informative, in the early 2020s or mid 2020s, which is what we're in now, Berkshire Hathaway, Buffett's company, actually has a pretty swelling cash pile. And that's actually at a new record. You can see this here topping the goal here. And actually in this chart, which looks like it's actually a little bit more up to date, that cash pile is over $300 billion. Now, this could likely be dry powder. Maybe it's anticipation for a potential pullback. Maybe it's also anticipation for purchasing a company or multiple companies. Who knows, right? I'm not in Warren Buffett's mind. I wish I was, but I'm not. But what I can tell you is what these charts say and what it could potentially mean. And one of the things I wanted to look at is, again, 2020 COVID. Now, COVID kind of came on pretty fast, right? Because it is actually, a disease, and then that triggered multiple different failures, cascading failures in the market. But you can see that leading up to 2020, again, there was a pretty big cash pileup. And in 2008, same thing when we're looking at the great financial crisis. Yeah, there was a pretty big cash pileup. And then in 2008, 2009, you could see that cash pileup decrease. Why? Likely because Warren Buffett and team pushed all that cash, all that dry powder into the market. Same thing happens in the dot-com bubble era, where there was a cash pileup again, so similar to today, just lower figures, of course. And then in the dot-com bubble, when it burst, that's when the cash pileup decreased. He put all of his cash working into the market and probably bought some great companies at pretty cheap prices. That is what I meant in the introduction with Warren Buffett waiting it out, but actually focusing more on the great price piece, right? Looking at companies that do have great prices, maybe some of them nowadays, and actually there are quite a few that are overvalued given today's AI boom, for example. All right, so moving on to the next point. I want to share the cash playbook with you. This is the CASH or cash playbook. First, I want you to look at choosing your lane. Are you an active investor or a passive investor? Next, it's all about that dry powder, exactly what we were talking about with Warren Buffett. The S stands for set rules to deploy. So the question is, when do you actually deploy all of your cash? What triggers those buys? And then finally, how do you handle emotions? Because emotions, we are human after all, we're not Spock, right? We do have emotions. That's what makes us real. That's what makes us human, not AI, for example. But sometimes emotions do get in our way, especially when it comes to the ups and downs of the stock market. So how do we kill them without actually causing, us to lose money, like the client couple I shared with you during the great financial crisis? They let their emotions get in the way, and those emotions cost them millions of dollars. Yes, it cost them millions. All right, let's move on and talk about the C here of the cash playbook, choosing your lane. I think this is pretty straightforward, right? You want to figure out, are you more of a passive or active investor? Passive, zooming in here, I kind of like the acronym ABB, always be buying, instead of the ABCs, right, which is what salespeople typically hear, always be closing. This year is always be buying, right? Always be buying stocks. Specifically using the DCA strategy, the dollar cost averaging strategy. It is an out of sight, out of mind strategy. It is automatic. And it's a type of set it and forget it. Even if the stock market goes down, you keep buying the same amount, the same stock or ETF, for example, at the same amount of money, and you just don't look. You don't worry about it. It's the same day of the same week or the same month, and you don't worry what's happening in the stock market. This was actually my strategy, and it helped me make over, I would say, 120% gain over about a 1 year period, especially after COVID. So DCA certainly works, and it works well. Let's look at active investors. Now, active investors are, I'd say, the minority, because these are people that generally like more the quant piece, so the more mathematical side. They generally have maybe a little bit more time. Maybe their job is actually investing related, so they have more time because they work in that field, which means they have access to possibly more research tools like the Bloomberg portal, which costs like $25,000 a year or a quarter. I don't remember which one. But either way, it's $25,000, if not more, since last time I looked. And there's also more variance, right? So if you are an active investor, you certainly can invest in maybe less known stocks or ETFs. Maybe you don't just invest in the S&P 500, you actually invest in a certain company. Maybe you actually hedge a certain company in the S&P 500. And that could give you, a bigger profit than the average person, the average passive investor, but it could also cause more losses, right? So certainly more variance there. But I did want to show you some charts, not just talk the qualitative side, but also show you some quantitative aspects here and show you that, passive ETFs, they've certainly acquired a lot of assets, right? So this y-axis here, you can see the assets under management, also known as AUM. You can see how much money is actually pouring into these types of ETFs or mutual funds. And you can see that passive ETFs have actually accumulated the most number of assets over the last roughly 20 years. Passive mutual funds are the second most. So you can see that passive assets are actually pretty popular with the population nowadays, while active ETFs, which you can barely even see, like if I zoom in, you can see this light blue line here. These are active ETFs. And active mutual funds, this light blue, have actually underperformed in terms of assets under management. And then also I wanted to share this picture here. I'm sure some folks will disagree. I would love to hear your comments in the comment box, by the way. But it is true that there are data out there about the failure of active management, right? So in other words, if you are looking to outperform, if you're an active manager, the percentage of active public equity funds that fail to beat the index. So here we're looking at the S&P 500 index. These are the active funds that fail to outperform the benchmark, the S&P 500. And you can see that there are quite a few funds, more with emerging markets, more with international, more with US mid-cap. But as you can see, it's not always easy to be an active fund advisor. Or at least invest in active funds, also because of the expense ratio. Typically, the expenses in active funds are much higher than passive funds. Why? Because active funds actually have people working in the fund and trying to make this the best investment that you own. And if there are people working, you have to pay their salaries, and that's why the expense ratio is typically higher. So moving on from the C in the cash playbook, we're going to move on to the A, the only vowel in the cash playbook. So A is accumulate dry powder. That's exactly what Warren Buffett is doing right now. For passive investors, typically opportunity for cash means having between 5 to 15% of your portfolio. So if your overall liquid portfolio for investing only, this does not include your emergency savings fund, is $100,000, then that means you want to have an additional $5,000 to $15,000 of cash in your portfolio, right? So in your liquid portfolio. It's important to have that cash there. Maybe you can put it into like a short-term money market fund. At least that's what I do. So I at least make something on my cash and not have it completely succumb to inflation. But this is the cash that you can use as dry powder. And it should typically, or at least I have it in my portfolio, because if I do see a buying opportunity, I literally press the button buy. And all I have to do is just literally type in the ticker symbol of the stock or the ETF or mutual fund that I want to buy with the cash available. If you keep the cash outside of your investment account in, for example, an emergency savings fund that's not connected to your actual portfolio, it might actually take like 1 business day or 2 business days to even transfer your cash into your investment portfolio. And then you have to click buy and put in the ticker symbol. And by that time, let's say 2 to 3 business days have actually passed. Maybe the opportunity of investing in that particular fund or ETF or whatnot that you want to invest in has also passed. So that's why I generally keep extra cash in my investment portfolio, just again to cut down on that time delay. Now, of course, if you had digital assets like maybe some sort of Bitcoin or other type of digital asset or digital cryptocurrency, then there probably would not be a time delay. But we're talking about actual cash and stocks and whatnot. So there is that time delay. For active investors, however, you might want to have a little bit more than passive investors. So the opportunity of cash that you want to have is probably around 10 to 30%. At least that's how I structured my client portfolios in the past. It really depends on the pipeline. Like it depends on your client or your own, risk tolerance, your own preference for assets. But generally, I would say it's somewhere around that range. So again, if you have $100,000 of invested money and you're an active investor, I'd probably want to have $10,000 to $30,000 on top of my $100,000 invested capital. All right, perfect. So also wanted to show you that it's not always positive, though. It is not always rainbows and butterflies, I think is the saying, right? Having dry powder is great because it does allow you to insert cash into the stock market when necessary. However, I wanted to show you the opposite, the other side of the coin, because having cash on hand instead of investing it maybe isn't always the best thing. And this graph, I think, does a good job showing it. Dry powder is a drag. Yeah, it can be a drag. I personally do have some dry powder because actually it helped me. It helped me actually quite a bit, especially during COVID. I had the dry powder. I pumped it in. I bought a ton of stock, or mainly it was ETFs actually, when the COVID was down because I had my buy triggers, which we'll get into here in the next couple of steps in the cash framework. I bought it and it really helped me, especially on the app shop at the end of COVID. However, this graph does show that if you do have dry powder, because it's in cash and it's not actually invested in the stock market, you do run the risk of actually not building out your portfolio to be as big as it could be. So here, if you had invested everything in a 70-30 portfolio, you would have about $5.2 million at the end of this time frame, 2025. But if you had about 20% of your money put or kept in cash or maybe short-term money market funds, well, then you're down to 4.5 million. So that's about a $700,000 difference. So, take it or leave it, but take it with a grain of salt, I would say, because having dry powder certainly does pull down your overall portfolio performance. Makes sense, right? It's not invested in the stock market, which generally does better than cash unless we're talking in down years. So look at this with both perspectives. It's good and it's bad. Let's move on to the S part of the cash framework. S is set rules to deploy. So when do you actually deploy your cash, assuming you do want to have some dry powder, like clearly Warren Buffett has? If you're a passive investor, you want to keep on DCAing, so dollar cost averaging, do not stop that, but then add a little buy boost when the market drops. And that's literally my strategy right here. This is what I did in order to get over 100% gain in a very short period of time. Now, for example, if you have, let's say, these are some rules you want to do, and these rules, they actually help versus feelings, right? So rules are much better than feelings. You want to develop these rules before we go into a bull or a bear market in this case as well. I just want to add that. Do not put these rules in place when we're in the middle of an economic crisis. You want to put these in place before an economic crisis. So, for example, if the stock market goes down 10%, so you see the minus here, the minus sign, then that's maybe when you want to add 25% more than usual than your regular DCA. So this could be a rule. Or maybe if the stock market decreases by 20%, you can add 50% for 2 to 3 cycles. So 2 to 3 DCA cycles. Or if the stock market goes down 30% or more, you can add 100% for 3 DCA cycles. So these are just some rules that you want to put in place and figure out what you're most comfortable with, right? So again, put them in place before the economic turmoil happens, because then that means your emotions are out of the rule-making process. And if you're an active investor, you want to watch for your dream price, however you calculate that dream price. There are many different ways to calculate these dream prices. This is not a quantitative video, so I'm going to skip over that. Understand why it's mispriced in the first place. So why is it mispriced today? And what would lead to your dream price occurring? And ultimately understand what the fair value range is. So maybe there is one dream price, which is X, but maybe your fair value range could be anywhere between X dollars to Y dollars. And then if the stock price falls, so if it goes down somewhere within this range, X to Y, that's when you actually trigger it, even if it's closer to Y. So X, for example, could be $50, Y could maybe be $80. So let's say the stock price does fall down to $79, you would still buy it at that point. Even though you think it could go lower, you would still buy it. And that's why it's so critical to have rules over feelings. And that leads us to our last point in the cash framework, which is handle your emotions. So I want you to take a look at this chart. This is greed versus buy, right? So this is from The Behavior Gap. It's a fantastic book. I highly recommend it by Carl Richards. And anyway, he drew this fantastic graph that looks at, greed, where the stock market goes up, everyone's feeling FOMO, they think they're going to miss out, and they want to buy, right? They want to buy and get into this excitement. But at some point, the stock market is going to burst, the bubble is going to burst, and then it goes down. And that's when most people are afraid, they become fearful that they're going to lose their losses. Think of my clients, for example. In the past, during the great financial crisis, they got worried. They sold everything. They kept it in cash, and they didn't repeat it because they just stayed in cash, which is probably worse. But in any case, you repeat it until you're broke. And that's a great way to do it. Wrong. If you want to do it right, it's the DCA strategy. That's one example. Yeah, you can also do like a lot of quantitative analysis, but the point is this year is typically when you want to sell. If you're an active investor, at least you want to sell at the peak and then buy at the bottom. That's the active investor mindset. And of course, we have, the news always driving our emotions. So for example, stock plunge in panic. So this year is pretty nerve-wracking. You see all these pictures, right, of the stock market going down, frenzy on Wall Street. This does not make me feel calm, right? Dow drops 508 points. I don't like that at all. Here we have another newspaper, Wall Street in panic as stocks crash. Not great, not great news either. And then we have this here, stock market crash, crisis, and we got these red signs. This is all terrible, and to me at least, it makes me very nervous. So just keep in mind, if it bleeds, it leads. That's the media saying. The media does monetize extremes, right? And they make money from that. That's why they post this stuff. So make sure you build on pre-commitments, right? So again, if you're a passive investor, create an auto DCA plan, buy boost rules, no all-in, all-out moves. So don't be like my clients that sold everything all at once or got in all at once. Like make sure it's kind of staggered and you follow your rules. And then also something that helped me as well is a cool-off timer. So I set it for 24 hours on any massive allocation changes. So for example, if you're thinking that you're going to go all into cash, you're going to sell everything you have because you think it's going to be Armageddon and the worst crash in history, worse than the Great Depression. Okay, if that's really your goal, if you really want to go into cash, set a cool-off timer, 24 hours. Think it through, sleep on it, talk to people if you want to. Get another opinion in there, do some extra research. I would go against it. I would not sell my own assets and go into cash. That's just my choice. But again, before you make any major changes, you certainly want to set yourself a timer. And then another thing is just make sure you have some progress metrics, right? Like or process metrics. How do you actually plan to implement certain rules or like this framework, for example, to make sure that you win, right? So the discipline absolutely beats IQ in bear market. And I'm going to scroll back up because I really think Warren Buffett's quote here was very, very well said. An idiot with a plan can beat a genius without a plan. So it's absolutely critical that you do have a plan in place. So going back down to what we were just talking about, make sure that you have a process in place because discipline wins all the time. So make sure finally that you review every single quarter. And that's honestly what Warren Buffett really does best. It's not about prediction, right? It's not about prediction. It's about preparation. Set your cash playbook now. So it's not this. It's about setting a cash playbook. That's what it's about. Okay. And the most important thing, as always, is start building wealth today. And if you found this video helpful, please like this video and share it to help others. I would love it as well if you subscribe to my YouTube channel. It's at @_MMW for more cool insights. And then make sure to join my newsletter. It's pinned in the comment section below for more exclusive tips. Thanks so much, and your bank accounts will thank you later.